Welcome to the deep dive. Today we're tackling something that, let's be honest, can feel a bit overwhelming. Corporate tax filing.
Mm-hmm.
Specifically, we're going deep on Form 1120, the U.S. corporation income tax return.
Right.
Now, I know taxes might not sound like the most thrilling topic, but hang with us. Understanding this form, it's not just busy work.
No, definitely not.
It's actually about finding real ways for your business to, save money and just run smoother. Okay, let's unpack this.
What's fascinating here is how just approaching Form 1120 systematically, step by step, can really shift your perspective.
Yeah.
Yeah. It
Okay.
goes from being this like dreaded annual chore to actually a clear path for improving your finances, getting that clarity. It really can turn it into an opportunity.
Exactly. And that's really our mission today. We want to equip you. Maybe you're a business owner just getting started, maybe a seasoned finance pro, or maybe you're just really curious about corporate taxes, equip you with the knowledge to handle Form 1120 effectively.
Hmm.
We're planning to go, item by item. Pinpoint those tax saving strategies, help minimize what you owe, and do it all completely within the IRS rules.
And those rules are key.
Absolutely. The IRS itself, they put out these burden estimates. They figure, on average, it takes about 100 hours for all taxable corporations to deal with Form 1120.
Wow, 100 hours.
Yeah, or about 50 hours if you're a smaller one. And that's just the time. That doesn't even touch the actual out-of-pocket costs, which, can easily run into thousands of dollars.
Right, prepare fees, software.
Yeah.
It adds up.
It does. So our goal here is simple. Help you cut down your slice of that burden by just being really well informed.
Mm-hmm.
Okay, so let's lay the groundwork, the real basics. Who actually needs to file this Form 1120 and fundamentally why?
Okay, yeah, good place to start.
Mm.
At its heart, Form 1120 is the official channel for corporations to report everything financial to the IRS.
Oh.
We're talking income, gains, any losses, deductions, credits, the whole picture.
And that determines their tax.
Exactly. It's how they figure out their income tax liability for the year.
Yeah.
Think of it like the corporation's annual financial report card, but specifically for the tax authorities.
Gotcha. And who specifically has to file this one? Is it just any company calling itself a corporation, or are there nuances?
Oh, there are definitely nuances, and getting this right is critical because filing the wrong form, that causes major headaches down the line.
I bet.
So the general rule is any domestic corporation files Form 1120, and that includes LLCs, limited liability companies that have specifically elected to be taxed as a corporation.
Okay. The check the docs election.
Precisely. But then you have a whole list of exceptions. For example, if an LLC is treated as a partnership for tax purposes, they file Form 1065.
Right.
S corporations, which are super common, they have their own form, Form 1120S.
Okay.
And then you have others, nonprofits with unrelated business income, use Form 990T, REITs. Real estate investment trusts use Form 1120 REITs. Insurance companies often use 1120 PC.
Wow. Okay. So lots of variations.
Lots. Cooperatives, political organizations, settlement funds, they all have their own specific forms. The absolute key right at the start is knowing your exact entity type and making sure you've got the correct form. It avoids so many problems.
Makes sense. So once you've nailed down that, yes, Form 1120 is the one for you, what about timing? What are the critical deadlines?
Yeah.
And where does this thing actually get sent?
Right. Deadlines are crucial. The general rule is the 15th day of the 4th month after the end of the corporation's tax year.
So for most companies using the calendar year, that's April 15th.
Exactly, April 15th. But there's a slightly different rule for corporations whose fiscal year ends on June 30th. For them, it's the 15th day of the 3rd month after year end, so September 15th.
Okay. Good to know.
And naturally, if any of these dates fall on a Saturday, Sunday, or a legal holiday, the deadline automatically bumps to the next business day.
Standard IRS procedure. What if you need more time?
You can get an automatic 6-month extension to file not to pay. Just to file by submitting Form 7004.
Form 7004. Got it. But the key is, you have to file that Form 7004 by the original due date of your tax return. You can't ask for an extension after the deadline has passed.
Right, makes sense. And the where to send it part.
Yeah.
You mentioned it's not always the same address.
Correct. It's not one size fits all. The specific IRS service center you mail it to depends on, well, a couple of things. Your corporation's principal place of business is the main one.
Okay.
And sometimes your total assets play a role. For instance, a lot of businesses on the East Coast or in the Midwest might send theirs to Kansas City, Missouri, whereas many in the West or South will file with Ogden, Utah. And if you're filing from a foreign country or a U.S. territory, there's a specific P.O. box address, also usually in Ogden.
So you really need to check the Form 1120 instructions for that year. Absolutely critical. The instructions list the specific addresses based on location, and sometimes that $10 million asset threshold comes into play for certain filers. Also, quick note on mailing. While you can use approved private delivery services like FedEx or UPS, and they count as timely mailed, they generally cannot deliver to P.O. boxes.
Ah, good point. So if the address is a P.O. box, you have to use the good old U.S. Postal Service.
You got it.
Now, what about e-filing? It feels like everything's moving digital. What are the requirements for corporations?
E-filing is definitely the direction things are headed, and it's mandatory for many now. The rule, effective for returns filed starting in 2024, is that corporations generally must e-file Form 1120 if they're required to file 10 or more returns of any type during the calendar year.
Any type, so not just income tax.
Exactly. That's the key part. It includes information returns like W-2s for employees, 1099s for contractors, excise tax returns, employment tax returns, all of it.
So if a company has, say, 15 employees getting W-2s.
They're almost certainly required to e-file their Form 1120 now.
Okay. That probably covers a lot of businesses.
It does. Now, if e-filing causes an undue hardship,
Right.
maybe lack of internet access, or some other valid reason, you can request a waiver from the IRS.
How do you do that?
You'd need to submit a written request, usually Form 8508, clearly explaining why e-filing is a hardship. But generally, the expectation is e-filing.
Got it. Okay, so the return is prepared, ready to go. Who actually signs this thing? It's a legal document.
Yeah.
And what if you used a paid tax preparer? Can the IRS just call them up if they have questions?
Good questions. The signature needs to come from an authorized corporate officer. That's typically the president, vice president, treasurer, assistant treasurer, chief accounting officer, or, any other officer who's been given authority to sign.
Okay.
If the corporation is under the control of a fiduciary, like a receiver or trustee in bankruptcy, then that person signs. They might need to attach a copy of the court order giving them authority.
And the paid preparer part?
If you paid someone to prepare your return, they must sign it in the designated Paid Preparer Use Only section. They also have to include their Preparer Tax Identification Number, their PTIN, and they're required to give you, the taxpayer, a copy of the completed return.
And the part about the IRS talking to them?
Right. There's a little checkbox in the signature area of Form 1120. If you check yes, you're authorizing the IRS to discuss that specific tax return directly with your paid preparer.
That seems useful.
It can be, yeah. It allows the preparer to answer IRS questions about the return, maybe provide some missing information, or respond to certain types of notices. It streamlines things.
But are there limits?
Oh, absolutely.
Yeah.
This authorization is pretty limited. Your preparer cannot receive your refund check. They can't agree to additional tax liabilities on behalf of the corporation, and they can't represent you in appeals or other more formal proceedings. It's really just for clarifying things about that specific return.
And it expires.
Yes, that's important. This particular authorization automatically expires no later than the due date of your next year's tax return. It's a temporary permission.
Okay, that's clear. Now, assembly. Once all the pages and schedules are done, is there a specific order they need to be put together in before you mail it or, I guess, package it for e-filing? Seems like the IRS would care about that.
They do care. Getting the order right definitely helps them process the return more smoothly.
Yeah.
There's a specific sequence. After page 6 of the main Form 1120, you start attaching schedules and forms.
What's the order?
It generally goes Schedule N, if applicable, then Schedule D, capital gains losses, then Form 4797, sales of business property, and it continues following the list in the instructions.
Okay.
After those specifically listed forms, any other schedules or forms you're attaching should go in alphabetical order by schedule letter and then numerical order by form number.
Alphabetical, then numerical. Got it.
And a really crucial tip the IRS emphasizes, don't just write C attached on a line on the main form. You need to complete every applicable line item on the form itself. The attachments are for the supporting details or calculations. And of course, make absolutely sure the corporation's name and employer identification number, EIN, are clearly visible on every single attachment.
Makes sense. So things don't get lost.
Exactly.
Yep.
And one more point on this after filing piece, record keeping. It's maybe not the most exciting part, but it's incredibly important.
Why is that?
You absolutely must keep copies of all your filed returns, the main form, all the schedules, all the supporting documents and worksheets. You'll need these for preparing future returns, obviously. Yeah. But also, if you ever need to file an amended return, Form 1120X.
Right.
And they're essential for things like calculating your corporation's earnings and profits which affects the taxability distributions to shareholders. It's basically your company's detailed financial history with the IRS. Keep it safe, keep it organized.
All right, let's dive into the real meat of the return the numbers. Page 1. But even before we hit income and deductions, there's that block of identifying information at the top. What are the crucial details we need to nail there?
Yeah, that top section, lines A through G, really sets the stage. Accuracy here is key. Beyond the basics like name and address, item A asks for your entity type.
We touched on that.
Right, but it also specifically asks if you're a personal service corporation, a PSC.
What defines that again?
A PSC is a corporation where the main activity is performing personal services. Think accounting, law, health, consulting, engineering, and those services are substantially performed by employee owners.
Okay. And why does that matter?
It can matter for tax rate purposes, although currently the flat 21% rate applies broadly, but correctly identifying as a PSC is still required.
Got it. What else up top?
Your employer identification number, the EIN, that's like the corporation's social security number. It has to be correct.
How do you get one if you're new?
You can apply online through the IRS website, which is usually the fastest way, or by fax or mail using Form SS4 if you've applied but haven't received it by the filing deadline.
Yeah.
For paper filing, you'd write applied for in the EIN box. But like we said, this can complicate or prevent e-filing, so it's best to get the EIN well before you need to file.
Okay. Total assets.
Yep. You report your total assets, valued according to your accounting method, as of the end of the tax year.
And those check boxes. Initial, final, name change.
Very important. Check initial return if it's the corporation's very first Form 1120. Check final return if the corporation has dissolved or ceased operations. This tells the IRS not to expect a return next year.
Crucial signal.
Absolutely. Name change. Check this if the name is different from the prior year's return. You likely also needed to amend your articles of incorporation with the state for that. Address change. Check if the address is different. And remember, if your address changes after you file the return, you should separately notify the IRS using Form 8822B.
Form 8822B for post-filing address changes. Good tip.
And finally, there's the Principal Business Activity Code. You look up a code based on the North American Industry Classification System, or NAICS, that best describes your main business activity. It just helps the IRS categorize businesses.
Okay, identification nailed down. Let's talk income. Lines 1 through 10. Where does the money come in according to Form 1120?
Right, the income section. It starts logically with line 1A, gross receipts or sales. This is your top-line revenue from selling your products or services.
Pretty straightforward.
Mostly. But there's an interesting election for some service providers here called the non-accrual experience method.
What's that?
It basically allows certain accrual method businesses not to recognize income for services they perform that, based on their past experience, they don't expect to actually collect.
Oh, interesting. So you don't pay tax on money you know you likely won't get.
Essentially, yes, within limits. If you use this method, you need to attach a statement explaining it. Then line 1B is for returns and allowances. This is where you subtract things like customer refunds, rebates, or other allowances that reduce your actual sales amount.
Okay, makes sense. Line 2.
Line 2 is cost of goods sold, to 8S. You don't just put a number here. You have a complete separate schedule, Form 1125A, cost of goods sold.
Ah, Form 1125A. What's on that?
That schedule breaks down your COGS calculation, beginning inventory, purchases, labor costs directly related to production, materials, supplies, overhead, all the direct costs of producing the goods you sold. The total from Form 1125A goes on to line 2 here.
Got it. So sales minus returns minus COGS gives you gross profit on line 3. What else counts as income?
Well, after gross profit, you add things like dividends, line 4, interest, line 5, gross rents, line 6, gross royalties, line 7, and capital gains, line 8, Schedule D. Then line 10 is other income.
The catch-all. What typically goes there?
It's a variety of things that don't fit neatly into the other categories. Some common examples you might see on line 10 are recoveries of bad debts, but only if you previously took a deduction for that specific debt when it went bad. Refunds of state or local taxes you deducted in a prior year, but only to the extent the deduction actually gave you a tax benefit back then.
Okay, the tax benefit rule.
Exactly. Also, things like income from certain biofuel producer credits might land here. Or, importantly, ordinary income from a trade or business activity conducted through a partnership you invest in.
Wait, ordinary income from a partnership goes here, but you said losses go somewhere else.
That's right. If the partnership generates an ordinary loss, that generally flows down to line 26, other deductions. You don't net partnership income and loss directly on the income lines here.
Interesting distinction. Anything else for line 10?
Sometimes you might see specific items like recapture amounts related to LIFO inventory accounting or income resulting from certain foreign branch loss transfers. It's really for miscellaneous income items that need to be reported.
Okay, income covered. Now for the part that usually gets more attention, deductions, lines 12 through 26. This is where businesses can actively reduce their taxable income, right? Big opportunities here.
Absolutely. This section is crucial for tax savings. Each line represents a potential deduction, and understanding the rules and limitations for each one is key. Let's walk through the major ones.
Please do.
Line 12, salaries and wages. This is generally your largest deduction, the pay you give your employees. Pretty straightforward. Line 14, repairs and maintenance. These are costs to keep your business property in good operating condition, not improvements that add significant value or extend its life. Those usually get capitalized and depreciated.
Distinction between repair and improvement?
Critical distinction. And there's an election here too. You can sometimes elect to capitalize certain repair costs if you treat them that way on your financial books and records. It affects the timing of the deduction. Line 15, bad debts. If a debt owed to your business becomes totally or partially worthless, you can generally deduct it. But remember, if you're a cash-basis taxpayer, you usually can't deduct a bad debt unless you previously included that amount in your income.
Right, because you never recognize the income in the first place.
Exactly. Accrual-basis taxpayers have already included it in income, so they can deduct it when it goes bad. Line 16, rents. Simple enough rent you pay for business property you use but don't own. Line 17, taxes and licenses. This is for state and local taxes. Income tax, property tax, sales tax paid on purchases if not capitalized, payroll taxes imposed on the employer, license fees.
Okay. But you mentioned earlier things you can't deduct here.
Yes, very important.
Yeah.
You cannot deduct federal income taxes. That's never deductible. You also generally can't deduct foreign income taxes if you choose to take the foreign tax credit instead. It's usually one or the other.
Credit versus deduction.
Right. And you can't deduct taxes assessed for local benefits that tend to increase the value of your property, like assessments for sidewalks or sewers. Those usually get added to the property's basis.
Good to know. What about line 18, interest? Sounds simple, but you flagged it as complex.
It is. Generally, interest paid or accrued on debt related to your trade or business is deductible. But the exceptions and limitations.
Oh, like what?
Okay, first what you can't deduct. Interest on debt used to buy or carry investments that produce tax-exempt income, like municipal bonds. Section 265B covers this.
Makes sense. Can't get a deduction for earning tax-free income.
Right. Also, prepaid interest. If you're cash basis and pay interest that covers more than the current tax year, you generally have to allocate it and deduct it over the period it applies to. Interest related to certain financial straddles usually has to be capitalized, not deducted immediately. And interest related to producing certain types of property, like constructing a building, often needs to be capitalized into the cost of that property under Section 263AF.
So lots of capitalization rules.
Yes. And then there's the big one for many corporations, the business interest expense limitation under Section 163J.
Section 163J, what's the rule?
For many businesses, your deduction for business interest expense in a given year is limited. The limit is basically the sum of your business interest income for the year, plus 30% of your adjusted taxable income, ATI, plus certain floor plan financing interest for vehicle dealers.
Okay, 30% of ATI. What's ATI?
Adjusted taxable income is, roughly speaking, your taxable income calculated without considering interest expense, NOLs, depreciation, amortization, depletion, and a few other items. The calculation can get complex.
And if your interest expense is more than that limit?
The excess amount, the disallowed interest, is generally not lost forever. You carry it forward to deduct in future years, subject to the same limitation in those years. You track all this on Form 8990.
Form 8990 for the interest limit. That sounds like a really important one.
It is for many businesses, especially those with significant debt. And there's another potential limitation under Section 267A for interest paid to related foreign parties under hybrid arrangements, basically. Deals designed to get a deduction here without income inclusion overseas. That's highly specialized.
Wow. Okay, interest is definitely complex. What's next? Line 19, charitable contributions.
Right, a nice deduction opportunity. You can deduct contributions made to qualified charitable organizations, those recognized under Section 170C.
Is there a limit?
Yes, a significant one. Your total charitable contribution deduction for the year, generally cannot exceed 10% of the corporation's taxable income.
Only 10%.
Yes, and that taxable income is calculated before taking the charitable deduction itself and also before certain other deductions like the dividends received deduction or any NOL carrybacks.
So you can't just donate massive amounts in a good year to wipe out your tax bill.
Correct. It's capped. However, there's a useful rule for accrual basis taxpayers. If your board of directors authorizes a contribution during the tax year, you can elect to deduct it in that year, even if you don't actually pay it until after year end, as long as you pay it by the due date of your tax return, not including extensions.
Oh, that's handy for planning.
Very. You need to make the election and attach a declaration. And what about contributions over the 10% limit? Are they just lost?
Good question.
No, they're not lost. Any contributions you can't deduct in the current year due to the 10% limit can be carried over and deducted in the next 5 tax years, still subject to the 10% limit in those future years.
5-year carryover. Okay, that's good.
Line 20, depreciation. This is where you deduct the cost recovery for your tangible assets, buildings, machinery, equipment, vehicles. It includes the regular MACRS depreciation and any Section 179 expense deduction you claim, which allows you to expense the cost of certain assets immediately. All this is calculated on Form 4562, Depreciation and Amortization.
Form 4562, another key form.
Absolutely. Line 21, depletion. This is similar to depreciation, but for natural resources, oil, gas, minerals, timber. If you harvest timber, you might need Form T-Line 22. Advertising, your standard marketing and advertising cost. Line 23, pension, profit sharing, etc. plans. Deductions for contributions your corporation makes to qualified employee retirement plans like 401k or defined benefit plans. Just remember, operating these plans usually requires filing separate informational returns, like the Form 5500 series, even if you don't make deductible contributions in a year. Penalties for not filing those can be steep.
Good compliance reminder.
Line 24, employee benefit programs. This is for contributions to other employee benefit plans not claimed elsewhere. Think health insurance premiums, group term life insurance, other welfare benefit plans. Line 25, energy-efficient commercial buildings deduction. Section 179D allows a deduction for qualifying energy-efficient improvements. You'd use Form 7205 to claim it. And finally, line 26, other deductions. The second catch-all. This is where anything else allowable that doesn't fit on the specific lines goes.
What kinds of things end up here?
Quite a mix. Amortization of intangible assets, like patents or goodwill, calculated in Part 6 of Form 4562 goes here. Deductions for certain business startup and organizational costs, you can deduct up to $5,000 immediately, phase out if costs exceed $50,000, and amortize the rest over 180 months. Sections 195 and 248 cover these.
Okay.
Reforestation costs, you can deduct up to $10,000 per year. Costs related to qualified film, television, or live theatrical productions under Section 181. And as we mentioned earlier, this is where you typically deduct ordinary losses passed through from partnerships.
Got it. That's a comprehensive list of deductions. But you also mentioned things that seem like expenses, but the IRS says no. Let's revisit those non-deductible items, the pitfalls to avoid. These often end up as adjustments on Schedule M1.
Exactly.
No.
Knowing what's not deductible is just as important as knowing what is, especially for reconciliation on Schedule M1 or M3. Let's highlight some big ones. Travel, meals, and entertainment. This area is full of traps.
I bet.
Travel expenses for someone accompanying an officer or employee, like a spouse, are generally not deductible unless that person is also an employee and has a legitimate business reason for the trip.
Yeah.
Meals are generally only 50% deductible. They can't be lavish or extravagant, and an employee of the taxpayer usually has to be present. A huge point of confusion. If meals are not separately stated from entertainment costs, the meal portion is generally not deductible at all.
Wow. Okay, so separate billing is key if entertainment is involved. What about entertainment itself?
Since the Tax Cuts and Jobs Act, most entertainment expenses are not deductible. Period. Think sporting events, theater tickets, golf outings. Not deductible.
Even if it's for business?
Even if it's clearly for business, the deduction was eliminated.
What about things like company parties?
There are exceptions, like certain recreational activities primarily for the benefit of non-highly compensated employees, like a holiday party. But general client entertainment, no deduction.
Okay, what else in this category?
Qualified transportation fringes, QTFs. Things like providing parking or transit passes to employees. The expense incurred by the employer for these is generally not deductible anymore under Section 274A4.
Even though it's a benefit to the employee?
Right, the employer doesn't get the deduction. Also, membership dues for any club organized for business, pleasure, recreation, or other social purposes, think country clubs, golf clubs, athletic clubs, are not deductible.
Flat out no.
Flat out no. And expenses related to entertainment facilities like maintaining a yacht, hunting lodge, or swimming pool are also not deductible, even if used for business entertainment.
Okay, travel, meals, entertainment, lots of restrictions. What else is commonly non-deductible?
Fines and penalties. Generally, you cannot deduct fines or similar penalties paid to a government or a specified non-governmental entity for violating any law.
So, traffic tickets, safety violation penalties.
Not deductible. There are very narrow exceptions, like certain restitution payments or amounts paid to come into compliance with a law, but the general rule is no deduction for penalties. And lobbying expenses. Costs associated with attempting to influence legislation at the federal, state, or local level, or trying to influence certain high-level federal executive branch officials are generally not deductible. There's a small de minimis exception for some in-house lobbying costs, up to $2,000, but that's it.
Good to know. These non-deductible items definitely explain why book income and tax income diverge. Okay, before we leave deductions, let's quickly touch on line 29A. Net operating loss, NOL deduction. What happens when deductions exceed income?
Right, an NOL. If the corporation has negative taxable income in a year, that loss can often be used to offset taxable income in other years. On line 29A, you enter the total NOL carryovers from prior years that you're deducting in the current year.
You mentioned carryovers. Do NOLs carry back too?
Historically, yes. But the rules changed. For NOLs arising in tax years beginning after December 31st, 2017, they generally cannot be carried back at all. They can only be carried forward.
No carryback for recent NOLs?
Generally, no. They carry forward indefinitely until used up. However, there was a temporary rule allowing carrybacks for certain NOLs arising in 2018-2020 due to the CARES Act, but the general rule now is carry forward only.
And you mentioned an 80% limit earlier.
Yes. For these post-2017 NOLs that you carry forward, the deduction you can take in any single future year is generally limited to 80% of your taxable income for that year, calculated before the NOL deduction itself.
So even a large NOL carry forward might not completely eliminate tax in a profitable year.
Correct. It can significantly reduce it down to 20% of the taxable income base, but maybe not to zero. The remaining NOL just keeps carrying forward.
Are there limitations on using NOLs if the company ownership changes?
Yes, absolutely. Section 382 imposes limitations if there's a significant ownership change. That's a very complex area, often requiring specialized analysis to determine how much of the pre-change NOLs can be used post-change.
Now, line 29B, special deductions. This sounds important, especially Schedule C for the dividends received deduction, DRD. Can you break that down? It seems like a major tax saver.
It absolutely can be. Schedule C, which feeds into line 29B, is primarily about the DRD. The whole concept is to mitigate what could otherwise be triple or more taxation of corporate earnings.
How so?
Well, imagine Corporation A earns profit, pays tax. Then it pays a dividend to Corporation B, its shareholder. Without the DRD, Corporation B would pay tax on that full dividend. Then if B pays a dividend to its individual shareholders, they pay tax again. The DRD provides relief at the corporate level.
So Corporation B gets to deduct some or all of the dividend it received from A.
Exactly. The percentage of the dividend that B can deduct depends on how much stock B owns in A.
What are the percentages?
If Corporation B owns less than 20% of Corporation A by vote in value, it can generally deduct 50% of the dividends received. If B owns 20% or more, but less than 80% for affiliated group rules, the deduction increases to 65%. And the big one, if B and A are members of the same affiliated group, generally meaning 80% or more common ownership, B can often elect to deduct 100% of the dividends received from A.
100%. That eliminates the tax completely at that level.
Precisely. It's a huge benefit for consolidated groups or closely related corporations, ensuring profits are only taxed once within the group before being distributed out.
Are there catches, nuances?
Always. Several important ones on Schedule C. Debt finance stock. If Corporation B borrowed money specifically to buy the stock of Corporation A, the DRD percentage, 50% or 65%, gets reduced proportionally based on the amount of debt financing. You can't get a full deduction on dividends funded by deductible interest payments. Holding period. This is critical. To claim the DRD, you must hold the dividend-paying stock for a minimum period, generally more than 45 days, during the 91-day period beginning 45 days before the stock goes ex-dividend. For preferred stock, it's a longer 90-day holding period within a 181-day window.
Why the holding period?
To prevent corporations from just buying stock right for a dividend, collecting the dividend with the DRD, and then immediately selling the stock, it has to be a real investment for a minimum time. And days where your risk of loss is diminished, like through hedging, don't count towards the holding period. Obligation for related payments. No DRD if you're obligated to make related payments on substantially similar property, like in certain short sale scenarios. Dividends from certain entities. Dividends from entities like real estate investment trusts, REITs or regulated investment companies, RICs, generally don't qualify for the regular DRD. Also, dividends from certain foreign corporations might qualify, but under different rules, like Section 245. Overall limitation, Section 246B. Generally, the total DRD for 50% and 65% deductions is limited to a corresponding percentage, 50% or 65% of the corporation's taxable income, calculated with some modifications.
Another percentage of income limit.
Yes, but here's a crucial exception, a real aha moment for tax planning. This taxable income limitation does not apply in any year in which the corporation has an NOL after taking the full DRD.
Wait, say that again?
If taking the full DRD without the taxable income limit either creates or increases an NOL for the year, then the taxable income limitation doesn't apply at all. You get the full deduction.
Wow. So the DRD itself can push you into a loss and you still get the full benefit.
Exactly. This can be a powerful tool. In a break-even or small profit year, maximizing the DRD, even if it creates an NOL, can be much better than taking a limited DRD due to the income limitation. That NOL can then be carried forward.
That's a fantastic planning point. Anything else major on Schedule C?
Line 22 mentions the Section 250 deduction, which relates to foreign-derived intangible income, FDII, and global intangible low-taxed income, GILTI. That's a very complex area related to international taxation. Definitely its own deep dive.
Understood. So after all that income deductions, NOL, special deductions, we finally arrive at line 30, taxable income.
That's the number, line 11C minus line 29C. This is the figure upon which the corporate income tax is calculated.
And if it's 0 or less?
You likely have an NOL for the current year, assuming no minimum tax rules apply, which is rare for most regular corporations.
Okay, we have taxable income on line 30. Now we move to calculating the actual tax liability. That happens on Schedule J, right?
Correct. Schedule J, tax computation and payment, is where it all comes together.
How does the calculation start?
It starts pretty simply on line 1A, income tax. You take the taxable income from page 1, line 30, and multiply it by the flat corporate income tax rate.
Which is currently
21%. So line 30 times 0.21 gives you your base income tax. Line 1B is for certain mutual savings banks, not relevant for most.
21% flat rate. Okay, what comes next? Credits.
Yes, credits are huge. They come after the initial tax calculation and reduce your tax liability dollar for dollar, which makes them very valuable. Line 6 is where you total up various tax credits.
What are some common credits corporations might claim?
Oh, there's a wide range, claimed on various specific forms that feed into Schedule J. Some frequent ones include the Work Opportunity Credit, Form 5884, for hiring individuals from certain targeted groups who face employment barriers. The credit for increasing research activities, Form 6765. The R&D credit, very important for innovative companies. The Disabled Access Credit, Form 8826. For small businesses that incur expenses to make their facilities accessible. Credit for employer Social Security and Medicare taxes paid on certain employee tips, Form 8846, common in the restaurant industry. Credit for small employer pension plan startup costs, Form 8881. Credit for employer-provided childcare facilities and services, Form 8882. And the General Business Credit, which is actually an umbrella for many individual business credits.
So lots of potential credits to investigate. These reduce the tax calculated on line 1A.
Exactly. They directly subtract from the tax owed. Schedule J also includes lines for other potential taxes, though.
Like what?
Line 8 is for the Personal Holding Company, PHC tax. This is an extra penalty tax on certain closely held corporations that have too much passive income, like dividends and interest, relative to their active business income. Requires filing Schedule PH.
Okay, something specific types of companies need to watch.
Definitely. Line 9 is for recapture taxes. If you previously claimed certain credits, like the Indian Employment Credit or New Markets Credit, and then later didn't meet the requirements, you might have to recapture or pay back some of that credit here. Line 10 is for other miscellaneous taxes, like certain interest charges on deferred gains.
So Schedule J totals up the main tax, adds any extra taxes, and subtracts the credits to get the total tax liability.
Precisely. That's the top half of Schedule J. The bottom half deals with payments.
Okay, payments and refundable credits. Once the total tax is figured, how does the corporation actually settle up? And what if they paid too much during the year?
This is where we account for payments made throughout the year. Line 14. Estimated tax payments. This is usually the biggest payment component. As we discussed, corporations expecting $500 or more in tax generally have to make quarterly estimated tax payments.
Due dates again?
Usually the 15th day, the 4th, 6th, 9th, and 12th months of their tax year.
And they have to be paid electronically.
Almost always, yes.
Yeah.
Using the Electronic Federal Tax Payment System, EFTPS, is the standard method. It's really important to accurately estimate your income and tax throughout the year and adjust payments if needed because underpaying can lead to penalties.
Okay, what's line 15, Form 4466, quick refund?
That's right. The Form 4466, Corporation Application for Quick Refund of Overpayment of Estimated Tax. If a corporation realizes after its tax year ends, but before it files its main Form 1120, that it's significantly overpaid its estimated taxes, it can use this form to get a faster refund of that overpayment.
What qualifies as significant?
The overpayment has to be at least 10% of the expected tax liability and at least $500. It's a way to get cash back quicker than waiting for the main return to process.
Handy. Line 17, tax deposited with Form 7004.
That's for any payment made with the application for an extension of time to file. Remember, an extension to file isn't an extension to pay. If you expect to owe money when you file Form 7004 for an extension, you should pay the estimated amount due with that form. That payment gets reported here.
Got it. Withholding.
Line 18 is for any federal income tax withheld from payments made to the corporation, which isn't super common for C-Corp, but could happen in specific situations like backup withholding. And then line 20, refundable credits. This is key.
Why refundable?
These are credits that can result in a refund even if the corporation owes no tax. Unlike non-refundable credits, which can only reduce tax to zero, refundable credits can generate cash back from the government.
Examples.
The main one here is often credit for federal tax paid on fuels, Form 4186, for taxes paid on fuels used for non-taxable purposes, like farming or off-highway business use. Also, credits from Form 2439 related to undistributed capital gains from mutual funds or REITs, or credits for tax withheld on certain payments to foreign persons under Chapters 3 or 4.
Okay, so Schedule J nets out total tax against total payments and refundable credits.
Exactly. This leads to either an amount owed, line 36, or an overpayment, line 37.
And if tax is due, when does it have to be paid?
Any tax due must be paid in full by the original due date of the return. That's April 15th for calendar year filers, even if you get an extension to file until October 15th. The extension is only for filing the paperwork, not for paying the tax. And payment, again, must generally be electronic via EFTPS.
Okay, last point on the section, line 37, overpayment. If the corporation paid in more than it owes, what are the options?
If line 37 shows an overpayment, the corporation has a choice on line 38. It can elect to have the overpayment. 1. Refunded to the corporation. 2. Credited to the next year's estimated tax.
Can they split it? Some refunded, some credited?
Yes, they can specify amounts for each. But here's the critical warning we mentioned earlier. This election is generally irrevocable. Once you file the return, choosing to credit the overpayment to next year's taxes, you usually can't change your mind later and ask for it back as a refund.
Irrevocable. That's a big decision point then.
It really is. Needs careful consideration of cash flow needs versus next year's expected liability. If you do choose a refund, you can request direct deposit by attaching Form 8050, direct deposit of corporate tax refund, providing your bank account information.
All right, we've navigated the core financials, but Form 1120 asks for a lot more information, doesn't it? Schedule K, other information, seems to have a ton of questions. What's really important there?
Schedule K is definitely packed with questions that give the IRS a broader picture of the corporation's structure and activities. Some are simple checks, others can trigger significant additional filing requirements. Let's hit some highlights.
Okay.
Question 7. Foreign ownership. This asks if, at any time during the tax year, one foreign person directly or indirectly owned 25% or more of the corporation's stock.
25% foreign ownership. What if the answer is yes?
If yes, and the corporation had certain types of transactions with that foreign owner or other related foreign parties, it likely triggers the requirement to file Form 5472, information return of a 25% foreign-owned U.S. corporation or a foreign corporation engaged in a U.S. trade or business.
Form 5472. You mentioned penalties earlier.
Yes, the penalties for failing to file Form 5472 when required, or for filing it incorrectly, are substantial. We're talking potentially tens of thousands of dollars per form per year. It's a huge compliance red flag area for the IRS. So answering question 7 accurately is step 1.
Definitely noted. What else on Schedule Pay?
Question 9. Tax-exempt interest. You need to report the total amount of tax-exempt interest received or accrued during the year, like from municipal bonds. Even though it's not taxed, the IRS wants it reported here. And remember, this amount also needs to show up on Schedule M1 or M3 as a book tax difference.
Okay, can expect a reconciliation.
Question 11. NOL carryback waiver. We talked about the net operating loss carry-forward rules. This question asks if the corporation is electing to waive the carryback period, to the extent any might still apply under transitional rules, and only carry the NOL forward. Checking this box makes that irrevocable election we discussed.
Strategic choice right there.
Very much so. Question 27. Digital assets. It's a relatively new and super important now. It asks a simple yes or no. Did the corporation receive, sell, exchange, or otherwise dispose of any digital assets during the year?
Digital assets meaning crypto, NFTs.
Exactly. Cryptocurrencies like Bitcoin or Ether, stablecoins, non-fungible tokens, NFTs, anything using cryptographically secured distributed ledger technology.
So when do you check yes?
You check yes if you did almost anything other than just buy or hold them. Examples. Receive digital assets as payment for goods or services. Receive them as a result of mining, staking, or a hard fork. Sold digital assets. Exchange digital assets for property, goods, services, or other digital assets. Otherwise dispose of financial interest in a digital asset.
What doesn't require checking yes?
Merely holding digital assets you acquired in a prior year, or transferring digital assets between wallets or accounts that you own and control, or just purchasing digital assets using regular US dollars or other real currency. Those activities alone don't trigger a yes.
Crucial distinction, and you have to answer.
Yes, absolutely. Cannot leave it blank. Check yes or no. How you actually report the tax consequences of those transactions, like capital gains losses on Form 8949 if held as investments, or ordinary income if received as compensation, is separate. But this question flags the activity.
Okay, digital assets check. What about controlled groups?
Question 28. Controlled group. Asks if the corporation is a member of a controlled group, parent, subsidiary, brother, sister groups with common ownership. If yes, you generally need to file Schedule O consent plan and apportionment schedule for a control group to allocate certain tax benefits, like the lower tax brackets, though less relevant now with the flat rate, among the group members.
Schedule O for controlled groups. Got it.
Question 31. Subchapter K basis adjustments. This is more technical, relevant if the corporation is a member of a controlled group and holds an interest in a partnership. It asks about reporting requirements if there are significant basis adjustments, like under Sections 734 or 743, or large built-in losses related to partnership interests.
Okay, that covers some key Schedule K items. Next up are the financial statements. Schedule L, balance sheets. What's required here?
Schedule L is pretty straightforward conceptually. It requires the corporation to provide its balance sheet assets, liabilities, and equity as per its books and records, not necessarily tax basis numbers. You need to show the balance sheet figures for both the beginning and the end of the tax year.
So a snapshot of financial position based on accounting records.
Exactly. It gives the IRS a comparative view of the company's financial health over the year, according to its own accounting.
Now, Schedule M1. Reconciliation of income per books with income per return. This sounds like where those book tax differences we keep mentioning really come into play. Why is this reconciliation so important?
Schedule M1, or its bigger sibling Schedule M3 for larger corporations, is fundamental. It's the bridge. It explains exactly why the net income or loss shown on the corporation's financial statements, its books, is different from the taxable income reported on line 30 of Form 1120.
And they're almost always different.
Almost always, because generally accepted accounting principles, GAAP, or other accounting methods used for books, have different rules than the Internal Revenue Code used for taxes. Things are recognized at different times, or some items are expenses for books but not for tax, or income for tax but not for books. M1 itemizes these differences.
Is every corporation required to file Schedule M1?
Not necessarily. There's an exemption for smaller corporations. If a corporation's total gross receipts for the year and its total assets at the end of the year are both less than $250,000, it generally does not have to complete Schedule L, balance sheet, M1 reconciliation, and M2 retained earnings.
$250,000 threshold for both receipts and assets. That helps a lot of small businesses.
It does simplify things considerably. But if you do meet those thresholds, or if your assets are $10 million or more, you need to reconcile.
You mentioned Schedule M3 for larger companies.
Right. If a corporation's total assets on a consolidated or non-consolidated basis are $10 million or more, it must file the much more detailed Schedule M3, net income loss reconciliation for corporations with total assets of $10 million or more, instead of Schedule M1. M3 requires a much more granular breakdown of book tax differences. Some smaller companies can also voluntarily file M3.
Okay. Focusing on M1 for now, what are common adjustments we'd see? You mentioned the non-deductible expenses.
Exactly. Line 5 of Schedule M1 is expenses recorded on books this year not deducted on this return. This is where many of those items land. The federal income tax expense recorded on the books, line 5A. The excess of capital losses over capital gains, line 5B, since corporations can only deduct capital losses against capital gains. And line 5C, travel and entertainment costs, is where you add back things like the non-deductible portion, usually 50% of meals, fully non-deductible entertainment costs, non-deductible club dues, expenses for entertainment facilities, non-deductible expenses related to qualified transportation fringes.
So you start with book income, add back expenses that aren't deductible for tax. What else?
You also adjust for income items. Line 7 is income recorded on books this year not included on this return. The classic example here is tax-exempt interest, like from municipal bonds. It's income on your books, but not taxable, so you subtract it here.
Ah, okay. Adds and subtracts to get from book income to tax income. What about those PPP loans we talked about? How do they fit into M1, M3?
Good question. That was a common adjustment. Forgiven Paycheck Protection Program, PPP loan amounts, are generally tax-exempt income. So if the corporation included the forgiven amount in its book income,
Which many did.
right, then on Schedule M1, line 7, or the corresponding line on M3, you would subtract that tax-exempt income amount. It reconciles the difference included for books, excluded for tax.
And the last piece of this puzzle, Schedule M2, analysis of unappropriated retained earnings per books. What's the purpose of this one?
Schedule M2 tracks the changes in the corporation's retained earnings account as shown on its books during the tax year.
So it starts with the beginning balance.
Exactly. Line 1 is the balance at the beginning of the year. Line 2 is the net income or loss per books. This should tie back to the starting point of Schedule M1. Line 3 adds other increases to retained earnings.
Then subtracts distributions.
Right. Line 5 is for distributions, cash dividends, property dividends, etc., that reduce retained earnings on the books. Line 6 is for other decreases. And line 8 is the ending balance of retained earnings per books, which should match the ending balance sheet on Schedule L.
It basically shows where the book profits went. Did PPP loans affect M2 as well?
They could, yes. There was a specific adjustment needed on M2, line 6, of the decreases. If the amount of PPP loan forgiveness income treated as tax-exempt on a prior return ended up being less than the amount actually forgiven, perhaps due to subsequent IRS guidance or calculation changes.
So if you initially claimed too much tax-exempt income.
Exactly. You'd report the decrease in tax-exempt income on M2, line 6, and attach a specific statement explaining the adjustment, referencing IRS Revenue Procedure 20-2148. It was about ensuring the retained earnings analysis accurately reflected the final tax treatment.
Okay, we've dissected Form 1120 and its main schedules, but you mentioned other forms and compliance aspects. It feels like filing the 1120 is just one piece of a much larger compliance puzzle. What else do corporations need to be aware of?
That's a great way to put it. It is a puzzle. And Form 1120 is the central piece, but definitely not the only one. Depending on the corporation's activities, many other forms and statements that be required. Missing them could lead to trouble.
Like what kind of forms?
Well, we already mentioned several. Form 1120X for amending a prior return. Form 4472 for transactions with foreign-related parties. Schedule O for controlled groups. Form 8990 for the business interest expense limitation. Form 4562 for depreciation. Form 1125A for CACs. But there are others. A really critical one is Form 8886, Reportable Transaction Disclosure Statement.
Reportable transactions.
Yeah.
Sounds serious.
It is. The IRS identifies certain types of transactions that have the potential for tax avoidance or evasion. These are called reportable transactions. They fall into categories like listed transactions, specific schemes the IRS has officially identified as abusive, confidential transactions, offered under conditions of confidentiality, transactions with contractual protection, where fees depend on the tax benefits being sustained, loss transactions, involving significant losses above certain thresholds, transactions of interest, similar to listed transactions, but the IRS needs more info.
And if a corporation engages in one of these,
They must disclose it by filing Form 8886 with their tax return for each year they participate. Failure to disclose carries severe penalties under Section 6707A, potentially hundreds of thousands of dollars, plus accuracy-related penalties on any understatement of tax under Section 6662A. This is not an area to ignore. If you think a transaction might be reportable, get professional advice immediately.
okay, Form 8886, high stakes. What else?
Material advisors who promote these transactions have their own reporting on Form 89CN. Specific corporate transactions often require attached statements detailing compliance with certain code sections, like transfers to controlled corporations, Section 351, or certain types of distributions, Section 355. Form 8938, Statement of Specified Foreign Financial Assets. Certain domestic corporations that hold foreign financial assets exceeding specific thresholds, like $50,000 at year-end or $75,000 at any time during the year, must file this form. It's part of FATCA compliance.
Foreign assets held by domestic core. Got it.
And for really large multinational groups, those with annual global revenue of $850 million or more, there's Form 8975, country-by-country report, providing high-level financial data for each jurisdiction they operate in. That's BEPS compliance.
Wow, a lot of potential extra filings. You also mentioned the trust fund recovery penalty earlier. Can you elaborate on that? It sounded quite serious for individuals within the company.
It is extremely serious because it pierces the corporate veil, so to speak. Certain taxes a corporation collects or withholds are considered held in trust for the government. The big ones are employee income taxes withheld, and the employee share of Social Security and Medicare taxes withheld from paychecks, reported on Form 941 usually. Also, some excise taxes.
So money withheld from employees.
Exactly. If the corporation fails to pay these trust fund taxes over to the IRS can assess the trust fund recovery penalty, TFRP. This penalty can be imposed personally on any individual who was 1. Responsible for collecting, accounting for, or paying over the taxes, ANT. 2. Willfully failed to do so.
Responsible and willful. Who counts as responsible?
It can be officers, directors, major shareholders, even certain employees, anyone with significant control over the company's finances and the decision-making power regarding which bills get paid.
And willful means?
It doesn't necessarily mean evil intent. It generally means they knew the taxes were due, had the authority to pay them, and either intentionally disregarded the obligation or were recklessly indifferent to whether the taxes got paid, like paying other creditors instead of the IRS when funds were limited.
So individuals can be held personally liable for the company's unpaid payroll taxes.
For the trust fund portion, yes. The penalty equals 100% of the unpaid trust fund tax. It's a powerful tool for the IRS to ensure these critical taxes get paid. It's a huge personal risk for anyone managing corporate finances.
Okay, that's a sobering thought. Let's talk about more general penalties and interest. No one likes paying extra to the IRS. What are the common triggers, and how can companies avoid them?
Avoiding penalties really comes down to timely filing, timely payment, and accuracy. The main penalties we see are estimated tax penalty, Form 2220. As we discussed, if your tax liability is $500 or more, you need to pay estimated taxes throughout the year. If you underpay, you'll likely owe this penalty, calculated based on the underpayment amount and period. Paying at least 100% of the prior year's tax, if it was a full 12-month year with liability, is a common safe harbor to avoid this.
Okay, the prior year safe harbor.
Failure to file penalty. This applies if you file your return late without a valid extension. It's typically 5% of the unpaid tax for each month or part of a month the return is late, capped at 25%. There's also a minimum penalty if the return is over 60 days late for 2025 returns. It's the smaller of $510 or 100% of the tax due. This penalty can be waived if you show reasonable cause for the delay.
5% per month. That adds up fast.
It does. Failure to pay penalty. This applies if you file on time or on extension, but don't pay the tax due by the original due date. It's generally 0.5%, half of 1% of the unpaid tax per month or part of a month, also capped at 25%. It's lower than the failure to file penalty, emphasizing the importance of filing on time even if you can't pay immediately.
Okay. And interest.
Interest is charged on any underpayment of tax from the original due date until the date it's paid in full. Interest applies even if you have an extension to file, and it also applies to unpaid penalties. The rate can change quarterly.
So interest is almost always a factor if you're late paying.
Almost always. Beyond these, there are accuracy-related penalties under Section 6662 if you substantially understate your tax liability due to negligence or disregard of rules, and even steeper penalties for fraud under Section 6663. And those specific penalties for reportable transaction understatements we mentioned, Section 6662A.
This raises a practical question. What should a corporation do if they receive a penalty notice from the IRS after they've already filed their return?
That's a great point. If you get a notice proposing a penalty after filing, don't ignore it. Read it carefully. If you believe the penalty was assessed incorrectly, or if you have reasonable cause for the failure that led to the penalty, like a natural disaster, serious illness, unavoidable absence, reliance on erroneous IRS advice, You should respond to the notice in writing.
Send an explanation.
Yes. Send a clear, concise explanation of why you believe the penalty should be waived, along with any supporting documentation. The IRS will review your explanation and determine if the reasonable cause criteria are met.
Is there anything you should not do?
A key tip from the IRS instructions. Do not attach an explanation requesting penalty relief when you initially file your tax return. You only address penalties if and when the IRS actually proposes or assesses them via a notice. Trying to preemptively explain potential issues on the return itself is generally not the correct procedure.
Wait for the notice, then respond. Got it. What if a company just can't afford to pay the tax owed?
If paying the full amount by the due date isn't possible, ignoring it is the worst option. The IRS offers options like installment agreements, allowing payment over time, up to 72 months usually. You can apply online or using Form 9465. There are setup fees and penalties, and interest continue to accrue, but it's a formal way to manage the debt and avoid more aggressive collection actions.
Okay, we have covered a tremendous amount of ground today, really diving deep into the mechanics and nuances of Form 1120, from the basic filing requirements through every line of income and deductions, credits, reconciliation. It's undeniably complex.
It really is. But hopefully breaking it down like this shows that it's manageable. And more than that, understanding these intricate instructions, it's not just about checking boxes for compliance. It really is about proactively managing and optimizing your corporation's financial position.
Yeah, you kept highlighting that. Every deduction, every credit, how you categorize things, how you handle dividends, each piece has a real dollar impact.
It does. Getting it right can directly save you money. Getting it wrong or overlooking an opportunity can cost you dearly, either in missed savings or through penalties and interest. It really underscores the value of careful preparation and understanding.
And that attention to detail, that systematic approach we tried to take, looking at each part, that seems to be what shifts tax filing from just this painful chore into something that's actually a strategic activity for the business. So what does this all mean for our listeners?
I think it means that by really grasping these fundamentals and maybe focusing in on a few specific opportunities that apply to your business, whether that's maximizing the dividends received deduction or properly classifying repairs versus improvements, or maybe navigating the new digital asset rules, or understanding the PPP loan reconciliation, you're doing more than just filing a form.
Yeah.
You're actively making decisions that shape your corporation's financial health and its future. You're using the tax code within its rules to your best advantage. That's powerful.
Exactly. Being informed is power when it comes to taxes. It lets you move from being reactive to proactive.
Well said.
So here's a final thought for everyone listening, something to maybe mull over as you head into your next tax season. Beyond just getting the numbers right, what unexpected strategic advantage could a deeper understanding of just one specific area we discussed today, maybe one deduction, one credit, one compliance rule, unlock for your business's growth or efficiency? Thank you so much for joining us on this deep dive into Form 1120. Until next time, keep learning, keep questioning, and keep exploring.